Forex, or foreign exchange, is the global market where currencies are traded. It is the largest and most liquid market in the world, according to a 2022 triennial report from the Bank for International Settlements, a global bank for national central banks. The daily trading volume for Forex reached $7.5 trillion in 2022. Forex trading involves buying one currency while simultaneously selling another currency. Traders aim to profit from changes in exchange rates between the two currencies. For example, if a trader believes that the value of the euro will rise relative to the US dollar, they may buy euros with dollars, and then sell those euros for a profit when their value has increased. Forex trading can be done through a broker or a financial institution that provides access to the market. Traders can use various tools and strategies to analyze market trends, such as technical analysis, fundamental analysis, and sentiment analysis. They can also use leverage to magnify potential profits, although this also increases the risk of losses. The main players in the Forex market include central banks, commercial banks, multinational corporations, hedge funds, retail traders, and institutional investors. 1. Central banks. Central banks are the most important players in the Forex market. They are responsible for setting monetary policy and managing the currency reserves of their respective countries. Central banks can use a variety of tools, including interest rate policy, to influence exchange rates and stabilize their currency. 2. Commercial banks. Commercial banks are the primary source of liquidity in the Forex market. They provide currency exchange services to their customers and engage in Forex trading to manage their own currency exposures. Commercial banks also play a role in facilitating international trade by providing financing and payment services. 3. Multinational corporations. Multinational corporations are major players in the Forex market as they operate in multiple countries and currencies. They engage in Forex trading to manage their foreign exchange risk, such as hedging against adverse currency movements that can impact their revenues and profits. 4. Hedge funds. Hedge funds are institutional investors that actively trade in the Forex market to generate profits for their clients. They often use sophisticated trading strategies and leverage to maximize returns. Hedge funds can have a significant impact on exchange rates as their trading activity can create large demand for currencies. 5. Retail traders. Retail traders are individual investors who trade in the Forex market through brokers. They usually have smaller trading volumes and use more basic trading strategies compared to institutional investors. Retail traders can use leverage to increase their trading positions and potential profits, but they also face higher risks of losses. 6. Institutional investors. Institutional investors such as pension funds, insurance companies, and mutual funds also participate in the Forex market. They invest in currencies as part of their overall asset allocation strategy and often take a longer-term view on currency trends. Forex, or foreign exchange, works through the exchange of currencies between market participants. The Forex market is a decentralized market, meaning that there is no central exchange where all transactions are processed. Instead, participants trade currencies electronically through a network of banks, brokers, and other financial institutions. Forex trading involves buying one currency while simultaneously selling another currency. Currencies are traded in pairs, with the exchange rate reflecting the value of one currency relative to another. For example, the exchange rate between the US dollar and the euro might be 1.20, meaning that $1 US can be exchanged for 1.20 euros. Traders aim to profit from changes in exchange rates between currency pairs. For example, if a trader believes that the value of the euro will rise relative to the US dollar, they might buy euros with dollars, and then sell those euros for a profit when their value has increased. Forex trading is facilitated through brokers or financial institutions that provide access to the market. Traders can use various tools and strategies to analyze market trends, such as technical analysis, fundamental analysis, and sentiment analysis. They can also use leverage to magnify potential profits, although this also increases the risk of losses. Overall, Forex trading can be a complex and volatile market, but with proper education and risk management, it can also provide opportunities for potential profits. In Forex trading, currencies are traded in pairs, with one currency being bought while the other currency is sold simultaneously. The exchange rate between the two currencies in the pair reflects the value of one currency relative to the other. The most commonly traded currency pairs in the Forex market are known as the major currency pairs. These include 1. Euro to US dollar, Euro/US dollar. 2. US dollar to Japanese yen, US dollar/Japanese yen. 3. Pound sterling to US dollar, British pound/US dollar. 4. US dollar to Swiss franc, US dollar/Swiss franc. 5. Australian dollar to US dollar, Australian dollar/US dollar. 6. US dollar to Canadian dollar, US dollar/Canadian dollar. 7. NZD/USD, New Zealand dollar/US dollar. These currency pairs are the most liquid and widely traded in the Forex market, representing the economies of major global powers such as the United States, European Union, Japan, United Kingdom, Switzerland, Canada, Australia, and New Zealand. In addition to the major currency pairs, there are also minor currency pairs and exotic currency pairs. Minor currency pairs include currency pairs that do not include the US dollar, such as Euro to Pound Sterling, Euro/British Pound, or Australian dollar to Canadian dollar, Australian dollar/Canadian dollar. Exotic currency pairs include currency pairs that involve emerging market currencies, such as USD/ZAR, US dollar/South African rand, or USD/BRL, US dollar/Brazilian real. Overall, there are dozens of currency pairs available for trading in the Forex market, each with its own unique characteristics and risks. Traders should carefully consider the factors influencing each currency pair and choose pairs that align with their trading strategies and risk tolerance. To start a trading career, it is enough to open an account with the Forex broker of your preferences. The spread or commission is the reward for the services of the broker. Trading strategies can be categorized into 4 further types. A scalp trade consists of cumulative positions held for seconds or minutes at most, and the profit amounts are restricted in terms of the number of pips. Day trades are short-term trades in which positions are held and liquidated on the same day. The duration of a day trade can be hours or minutes. In a swing trade, the trader holds the position for a period longer than a day, like days or weeks. If it's your first time visiting my channel and you have found value in the information shared, please kindly subscribe to my channel and hit the notification bell, and make sure you don't forget to like and comment. If you have already subscribed, thank you so much for your continued support. Bye bye for now, see you in my next video.